Hi guys! So, have you ever wondered what people really mean when they say, I'm investing in stocks, or I bought a few bonds, or even I put some money into real estate? Like, what does that actually mean? What even is an investment? And more importantly, where should you be putting your money right now to get the best return? Well, today we're diving into all of that. And by the end of this video, you'll not only understand the basics of investing, but also which investment options are making the most money for people today. So let's do this. Okay, let's start super simple. An investment is basically when you take your money and put it into something with the goal of making more money in the future. Think of it like planting a seed. You're hoping that over time, it grows into a tree that gives you fruit, or in this case, returns. And there's so many ways to invest, but the four big ones we're going to talk about today are: first is stocks and shares, second is bonds, third is real estate, and fourth is REITs, or real estate investment trusts. So let's break them down. First up, stocks and shares. These terms get thrown a lot, and honestly, they mean the same thing. When you buy a stock, you're buying a tiny piece of a company. So if you own a share of Apple, congratulations, you own part of Apple. And why would you want to do that? Because if the company grows and makes more money, your little piece becomes more valuable. You can either sell it for a profit or get paid dividends, which is like a bonus check just for holding the stock. For average returns, historically, the stock market, especially the S&P 500, it returns around 7 to 10% per year after inflation. But remember, stocks can be volatile. One year you might make 20%, another year you might lose 10%. It's a roller coaster, but a profitable one over the long term. Now let's switch gears and talk about bonds. Think of a bond like this. It's an IOU. You're lending money to a government or a company, and in return they promise to pay you interest and give your money back later. It's like being the bank. Bonds are usually seen as safer than stocks, especially government bonds. But they also usually give lower returns. For the average return, for US Treasury bonds, the return has historically been around 2 to 3% a year. And for corporate bonds, it can be higher, maybe 4 to 6%, depending on how risky the company is. So, not as exciting, but they bring stability to your investment portfolio. Moving on, let's talk real estate. This one's pretty hands-on, but, also pretty rewarding. You buy a property, like a house, apartment, or even a duplex, and make money in two ways. First, the property goes up in value over time, and it's called appreciation. Second is you rent out and earn monthly income. So it's like stocks and bonds had a baby, and that baby had bricks and a mortgage. So for the average return for real estate, it returned about 8 to 12% per year, depending on the market. If you manage it well, or invest in a growing area, you can make even more money. But keep in mind, it takes more money up front. It is less liquid, meaning you can't just sell it in a day. And there's maintenance, tenants, and taxes to think about. The next one is REITs, or real estate investment trusts. Okay, so what if you love the idea of real estate but don't really want to deal with broken toilets or chasing down rent? That is where REITs come in. A REIT is basically a company that owns a bunch of real estate, and you can buy shares in that company. It's like investing in real estate through the stock market. Pretty slick, right? The average return for this one has been 8 to 12% per year historically, similar to real estate but with more flexibility and less stress. Some of the best performing REITs recently have been in warehouses, data centers, and healthcare properties. And also, just an additional bonus because I like you guys, REITs have to pay out 90% of their profits to investors. So they're often great for dividends, which means passive income. And what are the best investments right now? Top performing investment types in 2024 to 2025 are tech stocks, companies in AI, semiconductors, green energy, such as Nvidia, AMD, and Tesla are popular names. Returns in 2024 were anywhere from 15% to 35% for these big hitters. Second is REITs in warehousing centers. I think Amazon warehouses or data hubs. So demand is booming and some REITs are seeing 10 to 14% annual returns. Third is I-bonds. These are government bonds adjusted for inflation. Not flashy, but safe. And during high inflation times, they've paid as much as 6% to 7%. Fourth is dividend growth stocks. These are companies that not only pay dividends, but grow them every year, like Johnson & Johnson or P&G, Procter & Gamble. It yields 2 to 4% plus long-term growth. So just remember, no investment is guaranteed. The best strategy is to diversify, meaning mix up your investments to balance risk and reward. So here's the takeaway from this video. Stocks are great for growth and long term. They build wealth and they're very liquid. Second is bonds, wherein it adds stability. They're like the seatbelt in your financial car. Third is real estate. It can be powerful, especially if you're hands-on and you get monthly income or even weekly income if you're doing Airbnb or daily income. But always remember, real estate is a bit harder to get into because you have to have a big deposit to buy the property, plus the fact that in maintenance, like the boiler, the tenants, and obviously the mortgage as well. So there's a lot to think about with real estate. Next is REITs, wherein it gives you real estate flavor without the heavy lifting. Plus, you get dividends every month. That's why I love REITs. I have probably 3 to 5 REITs in my portfolio, which is giving me probably, for one REIT, it's giving me £80 per month. And that's just one. The others, probably another £40 without me doing anything. I've just invested some money there and it's giving me money every month. And the best portfolio usually includes a little bit of all of this. Always remember, do not put in all of your eggs in one basket, because just in case one asset goes down, at least all of your money is not down the drain. Obviously, if you diversify, you put some of the eggs in other baskets that probably is still stable or might even go up. So, start small, stay consistent, and let time do its thing. Compound interest is your best friend, even if you're only investing $50 or £50 a month. It's a start, because 5 years from now, you'll be so glad you did it. Alright, That's it from me today. If you learned something new, please hit that like button and maybe share this with a friend who needs to get their money working for them, not just sitting in a savings account. Drop a comment below. Which type of investment are you most interested in trying? And remember, investing isn't about timing the market, it's about time in the market. So see you next time, guys. Ciao!